almost everything has hit a brand new record high. The S&P 500, record high. The Dow, record high. Bitcoin, record high. Real estate, record high.
Hey, I know why this stock is up, and it's justified. Because we're in COVID, who knows what it's going to be like on the other side.
And that bubble phase comes about when everybody is extrapolating the past and they say, oh, things are going to be better and I'm missing the boat.
Investors, enjoy this bull market. Trouble is coming.
I'm not here to tell you that we're in a financial bubble. Instead, I'll tell you, there will always be financial bubbles. To make sense of it all, let's go on a journey together. From the first financial bubble in history to what has been happening lately. Hopefully, through it all, you can make your own judgment of the current situation.
To unleash the full power of the federal government in this effort today, I am officially declaring a national emergency.
We saw our third trading halt in just 6 sessions right at the open, a 15-minute halt with the S&P down 7%.
Counted for a quorum is present. The motion is adopted.
With so many stimulus programs, trillions of dollars of cash started circulating in the market. A big part of it goes straight to the stock market.
Discount brokerage firms over the past few months get really slammed. First, Schwab got rid of commissions, forcing TD Ameritrade and E-Trade to follow suit. Then a couple weeks ago, we learned that Schwab is buying Ameritrade because they're desperate to consolidate. What's driving all this turmoil? You know what I think it is? I think it's Robinhood. It's the privately held operator that launched its commission-free brokerage platform in 2015. This company's been growing like a weed 10 times since we saw them last in 2016.
After some initial drawdowns, what happened next could be considered the strangest economic event in recent history. Stocks soared while real economic conditions declined, resembling an inflationary depression.
A speculative bubble is a fad. People get excited sometimes, too excited about phenomena. Prices start going up, they start talking, the newspapers start writing about it. More and more people pile into a market and they push prices up more, and it goes on for a while. It can't go on forever and eventually breaks and the bubble bursts.
Mississippi, a place frozen in time, a state where I went to college. It is the last place you associate finance with. But this old southern state was where the first financial bubble burst in history. In early 17th century, tobacco and slave trades were all profitable businesses for the French, allowing them to compete toe-to-toe with the Dutch. The Mississippi Company was established just to do that. Soon enough, the company was making large earnings. The public started to expect the company to keep performing well, demanding more shares in the company. The price for a share went from 500 to 18,000 livres. When you see a stock jump 36 times, you better ask yourself, can this company be 36 times better in the foreseeable future? A period of uncontrolled excitement led to a stock market boom across Europe. The French government took advantage of this by printing large amounts of paper money, causing violent inflation. In the meantime, the expected profits from the Mississippi Company were slow to materialize. Eventually, the share price collapsed in the end of 1720, causing a general stock market crash in Europe. Fortunately, that was the first and also the last time a bubble ever popped. People learned their lessons and passed them down to future generations. Investors started to manage their expectations. The market became highly efficient. Financial crisis never happened again.
The collapse of Lehman Brothers set off a wave of panic on Wall Street. With the U.S. economy already reeling, the government denied the 158-year-old bank the emergency funding, the liquidity it needed to survive.
In September 2008, the collapse of Lehman Brothers and the world's largest insurance company, AIG, triggers a global financial crisis. This is no accident, but every time a bubble popped, it seemed to have created more damage than a previous one, causing more hardships to everyday people. Because the world is more connected now. However, with every crisis, there is always a small group of people, the contrarians, who could see the bubble before everybody else. Many hedge funds were the big winners of 2008.
Everything that happens has a cause, and by understanding that process and cause, you know the red flags. And with those red flags, you know how to calculate whether people can pay their debts back and how the dynamic's going to work.
Ray Dalio manages the world's largest hedge fund that deploys a global macro strategy. Ray Dalio creates universal investment principles by learning from history. He analyzes how different countries, cultures, and people around the world react to different incidents like debt or oil shocks. In 2006, Ray Dalio saw the economy was overheating. As a precaution, he ordered his firm's traders to do investments that would be least affected: US Treasury bonds, gold, and the yen. He recently published an article on the likelihood if we're in a bubble. His conclusion is unexpected. Based on his indicators, he concluded that some stocks are in extreme bubble states, while other stocks are not in bubbles at all. He also hinted that his fund has been gradually shifting to those non-bubble stocks. Like a good independent thinker, let's not take what he said as given. Instead, let's go through a reasoning process from first principles. Arguably, the most important component of an economy is corporations, which are nothing more than a group of people doing productions. A stock is a claim to the cash earned by that production. Therefore, the only reasonable way to have true wealth over the long run is to own that production of the economy, the corporations, making you a capitalist. That is why the wealthiest people in the world either start their own companies or own shares of other companies. This pursuit of wealth can also make people lose the basic notion of value. It all comes down to expectation. How much cash can you expect from a company in the future? In finance, this is called the discounted present value of future cash flows. A stock market is a place for people to buy and sell ownerships of companies. At any moment, you can check the latest bid and ask price for any stock. They represent the prices that people are willing to buy and sell at. Since we're in a free market economy, anyone can just join the stock market. It is almost inevitable, at some point, the majority of buyers and sellers might price a stock incorrectly because the future is uncertain and no one has perfect information. But once in a while, you come across certain securities whose prices are so detached from reality, beyond any reasonable explanation. That is when a bubble might happen. That is why Ray Dalio said a great majority of tech companies are in a bubble state. It is so important to think independently. Nowadays, there's so much information out there, and most of it are just opinions of other people. What we want to do is to gather facts for ourselves and analyze them based on logic and common sense before listening to everybody else.